Restaurant Brands International completely crushed their Q1 2026 earnings. I mean, we're talking a 10.7% jump in overall adjusted operating income in a pretty tough macroeconomic environment. But if you looked at Wall Street's reaction, you'd honestly think the sky was falling. The stock just plummeted, wiping out billions in market cap in a matter of hours. The market brutally punished the stock over some short-term noise, and by doing that, they are completely mispricing a massive accelerated transition happening right under the hood. There is a quiet but incredibly aggressive pivot underway to a 99% high-margin franchise model, and frankly, the market is entirely missing the forest for the trees here. Negative 5.5%. That was the immediate stock drop on May 6th, 2026, literally the exact same day they announced those double-digit bottom-line earnings. It's wild. This single data point is the ultimate proof of just a massive market disconnect. Wall Street sold the news based on a temporary, highly localized sales slump at one specific brand, and in all that panic, they completely missed the structural pivot that's setting up a multi-year margin expansion for one of the largest restaurant operators on the planet. So, to understand why this disconnect represents such a fascinating opportunity for us, we got to look at what this company actually is and what a pivot of this magnitude physically requires. We're talking about a massive, global empire, over 33,000 restaurant units spread across more than 100 countries. It's not just one brand, it's four absolute icons: Burger King, Tim Hortons, Popeyes, and Firehouse Subs. They serve completely different demographics, from morning coffee commuters up in Canada to late-night drive-through traffic in the American South, all the way to rapidly expanding middle-class consumers over in Asia. But here's the real story. The operational shift the market is largely ignoring. Management is accelerating the divestiture of their corporate-owned stores. Look, in the restaurant business, running a store yourself is brutally capital-intensive. You hold the lease, you pay the labor, you absorb the food waste, and you manage the day-to-day chaos of the kitchen. A franchise model, on the other hand, shifts almost all of that operational friction and capital expenditure straight onto the franchisee. It leaves the parent company to just sit back and collect a top-line royalty check. Restaurant Brands International is moving years ahead of schedule to shed its remaining low-margin corporate operations and return to a nearly 99% asset-light franchise model. Let's dive into Section 1, the economic engine, scale, royalties, and the moat. How this company actually handles its nearly $48 billion in system-wide sales is the entire foundation of this thesis. The economic engine of an asset-light franchisor isn't actually about selling burgers, chicken, or coffee directly to a consumer. It's about generating highly predictable, recurring, insulated cash flows. They do this mostly through franchise royalties, usually taking a 4 to 5% cut of every single dollar that comes through the register, regardless of whether the franchisee actually makes a profit on that specific sale. They also make money on property leases to their franchisees and a super lucrative vertically integrated supply chain where they literally manufacture and distribute the coffee and baked goods for Tim Hortons across Canada. But when you look at the margins, there is a massive valuation gap. Right now, QSR operates with about a 27% operating margin across its 33,000 units. Compare that to McDonald's, right? The gold standard of the industry. McDonald's consistently operates at a massive 45% operating margin across its 43,000 units. So why the severe 18-point gap? It comes down to a structural decision management made recently. QSR acquired thousands of low-margin, decaying corporate stores from struggling large-scale franchisees like Carroll's Restaurant Group. When you buy back hundreds of broken Burger Kings, suddenly all that store-level labor, high food costs, and busted equipment hits your corporate balance sheet, dragging your margin to 27%. But guys, this is exactly the catalyst. The parent company never intended to run these stores permanently. They used their massive corporate balance sheet to buy them, fix them, and stabilize them. Now management is aggressively sunsetting that low-margin restaurant holding segment by 2027. They're systematically refranchising those newly repaired stores to better, well-capitalized operators. As those stores leave the corporate books, the heavy operational expenses vanish, leaving behind pure, high-margin royalty streams. This is the exact lever being pulled to capture multiple expansion and close that vast valuation gap with McDonald's. And protecting that multi-year transition is one of the deepest structural moats in the entire consumer discretionary sector. In fast food, we usually think of consumer loyalty as being pretty fragile, right? A customer can switch from Burger King to Wendy's in a heartbeat just because the drive-through line is too long. But while everyday consumers can switch choices easily, franchisees absolutely cannot. Franchisees are locked into 10 to 20-year master franchise agreements. When an operator signs one of these agreements, they're committing massive upfront capital. They've got to secure the real estate, build the physical structure, install highly specialized kitchen equipment tailored just for that brand, and commit to local advertising minimums. You can't just wake up one morning, rip down the Burger King signs, and start selling your own independent burgers without facing catastrophic financial penalties and losing millions in sunk costs. That creates immense, multi-decade corporate stability. Add that massive switching cost to dominant brand equity, like Tim Hortons commanding an unbelievable 70% market share in Canadian brewed coffee, basically acting like a daily utility for the whole country. Then factor in the unmatched global scale needed for volume commodity pricing. When you're buying millions of pounds of beef and poultry, you get pricing power that independent restaurants simply can't access, which insulates the broader system when inflation hits. All of this combines into a deeply entrenched, highly durable economic moat. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. To make this franchise model really thrive, the unit economics at the individual store level have to be flawless. The crucial growth engine for their domestic operations right now is the Reclaim the Flame initiative. This is a massive $700 million co-investment turnaround plan, specifically targeting Burger King in the US, which had historically suffered from underinvestment and dated real estate. The goal here is to aggressively upgrade 85% to 90% of all US stores to the modern Sizzle format by 2028. And this isn't just a fresh coat of paint. The Sizzle format fundamentally redesigns the economic throughput of the restaurant. We're talking dedicated digital ordering kiosks, double drive-through lanes specifically designed to separate mobile pickup orders from traditional ones, and massive kitchen efficiency upgrades that literally reduce the physical steps an employee has to take to assemble a Whopper. By moving customers through the system faster and using fewer labor hours to do it, this $700 million investment is designed to permanently elevate franchisee profitability, which in turn fuels the corporate royalty engine. Moving on to Section 2, the Q1 2026 disconnect, or what the market actually fears. If this turnaround is so promising and the margins are structurally expanding, we really have to ask, what has Wall Street so spooked right now? Well, it basically boils down to severe macroeconomic headwinds squeezing low-income consumers, combined with a highly localized brand stumble that triggered widespread panic on earnings day. Let's break down the actual evidence from the Q1 2026 earnings report that came out on May 6th. Overall, the company delivered a beat on bottom-line expectations, and they explicitly maintained their full-year guidance. Looking at the segment data, the core engines are firing. Burger King posted a very strong 5.5% growth in system-wide sales, proving that those Reclaim the Flame remodels are actually driving traffic. Tim Hortons was up a steady 2.4%, proving its resilience as a daily habit. But then, we look at the bottom line for Popeyes, a severe 6.5% comparable sales contraction. This is the exact number Wall Street algorithmically zeroed in on. Management was super clear on the earnings call about why this happened. They pointed to a lower-income consumer who's feeling the pinch of sustained inflation and pulling back on those premium-priced chicken combos. Plus, Popeyes was facing a tremendously difficult year-over-year comparison against a wildly successful new product launch in the prior year that temporarily spiked sales. That single negative comp sales number at Popeyes completely overshadowed the broader reality of the business. The market totally ignored that the parent company's overall adjusted operating income, the actual profitability of the enterprise, grew by an incredibly impressive 10.7%. Investors dumped the stock over a temporary chicken slump, completely missing the forest for the trees. Now, the market's fear isn't entirely irrational because we have to address the elephant in the room, 4.2x. That is the company's net debt to EBITDA leverage ratio. They are currently carrying roughly $13.35 billion in debt on the balance sheet. In a zero interest rate environment, carrying 4 times leverage for a highly predictable royalty business is perfectly fine. But in a macro environment where rates stay higher for longer, that elevated leverage makes institutional investors extremely nervous. The mechanical reality of debt is that it eventually matures and has to be refinanced. If they're forced to refinance large chunks of this $13 billion at significantly higher interest rates, that resulting interest expense is going to eat directly into their free cash flow, threatening their ability to sustain their dividend and fund those corporate remodels. Management is acutely aware of this. Their stated goal is to reach investment-grade leverage by 2028, pulling that multiple down closer to 3x, using their expanding free cash flow from the refranchising pivot. But make no mistake, this debt reduction plan is the ultimate high-wire act for this entire investment thesis. Let's look at Section 3, the qualitative scorecard, measuring true business quality. Let's synthesize the qualitative health of the business to see if the underlying foundation can actually support this ambitious, multi-year turnaround and aggressive debt reduction plan. When we evaluate the qualitative scorecard, a really clear narrative emerges. We have a business with incredible top-line stability anchored by a surprisingly fragile balance sheet. Our analysis gives the company a blended score of 7.7 out of 10. On the strongest side, revenue quality earns a near-perfect 9 out of 10. This is because those 4% to 5% franchise royalties are structurally insulated from store-level inflation. Even if the cost of tomatoes skyrockets, the parent company takes their percentage right off the top line before those expenses are even calculated. Business viability is also a 9, driven by their massive, diversified global footprint that essentially prevents a regional recession from crippling the entire enterprise. Management alignment is solid at an 8 out of 10, largely because leadership compensation is heavily tied to performance shares that only vest if long-term total shareholder return metrics are met, keeping them from just pumping short-term earnings. But then we hit financial health, which scores a pretty sobering 6 out of 10. This directly reflects their capital allocation track record over the last few years. Historically, they've prioritized aggressive dividend payouts and stock buybacks while letting that $13 billion debt pile sit there. That historical constraint limits their financial flexibility today, leaving them with less agile cash reserves to deploy if consumer spending takes a massive unexpected dive. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; and dividend hunters, durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, Section 4, 5-year scenario analysis, looking at the valuation framework. Before we dive into the numbers, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Let's start by looking at the base case, which carries a 50% probability from the current price of $72.47. Operationally, what has to happen to hit these numbers? Well, this scenario assumes that the Burger King Reclaim the Flame modernization is fundamentally successful in the U.S., stopping the market share bleed to McDonald's and Wendy's. Globally, we assume net new restaurant growth holds steady at a historically achievable 3.5 to 4% annually. Under these conditions, as they continue to open new stores globally while raising menu prices marginally alongside inflation, Year 5 revenues scales past $12 billion. Crucially, as that 99% asset-light transition finishes and the low-margin corporate stores are completely refranchised, net profit margins organically expand to hit 19%. By assigning a reasonable, conservative 19x valuation multiple to those earnings, we arrive at an implied share price of $101.08. That represents nearly a 60% total return over the 5-year period, purely driven by executing their stated plan without any major macroeconomic miracles. But what if everything aligns perfectly? The high case, assigned a 25% probability, requires a few specific operational catalysts. First, their massive master franchise agreements in Asia, particularly the Burger King and Tim Hortons joint ventures in China, have to drastically accelerate unit expansion, capturing vast amounts of the emerging middle class. Second, the rapid refranchising of U.S. stores executes faster than expected, pushing overall corporate net margins up to a highly efficient 20%. And third, because of this massive cash generation, the company successfully pulls their leverage ratio down to an investment-grade level well ahead of the 2028 schedule. The mathematical reality is that when a company de-risks its balance sheet by eliminating billions in debt, the broader market rewards them with a much higher valuation premium. In this scenario, the market grants them a 22x exit multiple, which falls right in line with premium peers. This operational scale and multiple expansion drives a $142 price target, representing a massive 117% return. But we absolutely have to look at the reality check, because the bear case is very real. The low case, which also carries a 25% probability, assumes a prolonged North American consumer recession. In this scenario, persistent core inflation deeply degrades franchisee unit-level profitability. And when franchisees aren't making money, the entire system fractures. If Burger King operators are strapped for cash, they simply halt the sizzle remodels. They stop building new drive-thrus, they delay kitchen upgrades, and foot traffic plummets as the brand feels stale compared to better capitalized competitors. As a result, the parent company's Year 5 revenue completely stalls at $10.4 billion. Because they are still carrying the heavy interest expense of their debt, net margins compress to 17%. As growth evaporates, the market ruthlessly punishes the stock, causing the valuation multiple to contract down to 15x. This structural failure drops the share price to $59.02, effectively wiping out 5 years of capital returns and leaving investors with 0 to negative growth over half a decade. So let's do the math clearly to synthesize these outcomes.
by applying a 50% weighting to our $101 base case and a 25% weighting to both the $142 high case and the $59 low case, we bridge to a probability-weighted price target of $100.80. What this ultimately reveals is the asymmetric risk-to-reward profile presented by this 99% franchise pivot. At today's prices, this blended target represents roughly 39% potential upside. The market is basically pricing the stock as if the low case is almost a certainty, which creates a significant margin of safety if management simply executes the base-level turnaround. And remember, if you want to dig into the exact line-by-line revenue and margin projections, the full detailed model behind all of these assumptions is available to review on Flash.
Section 5. Risk Analysis. What could break the thesis? We have to transition into the concrete risks that could permanently derail this turnaround. We have to make the bear case feel just as urgent, intelligent, and real as the bull case. These core thesis breakers are not theoretical. They are active threats playing out right now. Number 1 is severe beef and poultry cost inflation. Fast food is fundamentally a commodity business, and record-high beef prices have already crushed Burger King U.S. franchisees' average unit profitability down to roughly $185,000 per year. Why does a corporate shareholder care about a local franchisee's profitability? Because if a franchisee is only clearing $185,000, they cannot secure the commercial bank loans required to fund a $1 million store remodel. If the franchisees can't fund the remodels, the locations decay, traffic drops, and the corporate royalty growth engine simply stops cold. This is the absolute earliest warning sign investors must watch for over the next few quarters: franchisee default rates. Add to that the stubborn 4.2x net debt in a high-rate environment, which acts like an anchor on free cash flow. Finally, there's the looming threat of joint employer labor regulations. If federal labor boards successfully rule that corporate franchisors are jointly liable for the hourly employees hired by local franchisees, it would completely shatter the asset-light model. Suddenly, the parent company would face massive legal liabilities, unionization dives, and administrative costs for hundreds of thousands of workers they don't actually employ. It is a regulatory risk that could structurally break the entire 99% franchisee thesis. So, when we weigh this incredible economic moat against the very real balance sheet constraints, is Wall Street truly missing the forest for the trees? Let's recap the 3 most important takeaways from this deep dive. First, the 99% asset-light pivot is not a long-term dream, it is actively accelerating years ahead of schedule. Second, because of that rapid divestment of low-margin corporate stores, a massive impending margin expansion is quietly unfolding right now, setting them up to close the valuation gap with industry leaders. And third, to pull this massive transition off, management is walking a highly delicate tightrope, tasked with managing over $13 billion in debt while simultaneously funding a $700 million national brand turnaround. This thoroughly resolves our original curiosity gap. The market severely punished this stock because of a temporary consumer-driven Popeye sales slump, completely overlooking a multi-year structural transition that changes the entire math of the business. Restaurant Brands International is aggressively divesting its low-margin corporate stores and returning to its foundational roots. It's a quiet, powerful transformation of their operational blueprint into a high-margin return to form. The economic engine is being fundamentally upgraded, the risk profile is shifting from corporate operations back to franchisee execution, and the market, entirely focused on a single quarter of chicken sales, is completely missing the bigger picture. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.